Life Insurance Corporation is in focus after a stellar set of numbers this quarter, and in fact beating street expectations, especially on margins and value of new business margins. To understand how this performance has come about and what was expected to be a tough quarter because of GST changes, etc., I'm speaking with our Doraiswamy, the CEO and MD. Sir, thank you so much for your time to us here at NDTV Profit.
Thank you for having me on the show also.
No, pleasure to have you on. So let's just start with the core numbers and what has worked this quarter, because it was expected that there'll be a hit from GST, and there was a hit because of GST changes.
One, the GST changes kicked off only on the 22nd of September. So the effect was only for 8 days. The continued focus on improving the core business contribution to the profits has been there. And that is the main reason. One, our contribution from the core business, plus an improved investment return, as well as rationalization of expenses. All the three things have contributed for our improved profit numbers for the quarter. Last year, you are aware that IRDA rolled out a new master circular on products, and we had to be compliant with the circular. We had to make some changes to the product lines that we had. So from 1st October 2024, we have been seeing a difficult phase where we could not show a growth over the earlier year in terms of number of policies sold. Predominantly because we increased the minimum sum assured from 1 lakh to 2 lakh, and those policies which are sold below 2 lakhs could not be repeated. That is the reason. But that also had an indirect contribution in the form of improved top line, because improved bottom line because of the contribution that they came from the products as well.
So let's come to it one by one. I want to talk about GST a little more. You're right, the impact maybe came in the last 8 days, but deferred decisions also took place in anticipation of GST. And I think that has impacted the first half as well.
Yeah, first half, we had, the entire September, we had this tough phase because the GST reforms were announced on the 5th of September, and they had the effect only from 22nd September. So during the period of those 15-16 days, absolutely the new business procuration came to a virtual halt, kind of. And there was a delay, and the last 8 days were not sufficient to compensate for the loss of business that happened during those 15-16 days. That is one part. The second part is that we had a much high base last time, because on 30th September, we went for a total modification of products, and the existing products are withdrawn on 30th September. So there was a huge last minute sale that came in the last week of September, which could not be matched in the current year. That's also the reason.
So do you see volumes compensating for the September phase that you're seeing now that GST norms have come in, it has become easier for people, etc.? Do you see that volume growth coming in, and what is the impact of the lack of input tax credit that you see going forward?
We are looking at the benefits that accrue to the customers by way of this GST reforms. We have passed on the entire benefit to the customers, thereby the policies have become more affordable now than what it was before these reforms came in. So we expect a very good response to that by way of increased top line growth in the second half of the current year. Certainly we are looking at a good growth over the last year that is expected because of, one, this GST reforms as well, the products having been made more affordable. Two, we are also looking at continuing to work on the rationalization of expenses. So we expect the expenses to be under control that we have been trying to bring in the last 2-3 years. So that is also one more area of focus that we'll be working on. The impact of GST we are trying to manage by both an improved performance in the top line and the contribution that is going to come from the core business because of the rationalization of expenses, as well as increased ticket size that we are expecting in the quarters to come.
Okay. In terms of the actual hit, what do you see as the extent of the hit because of the lack of ITC or input tax credit? Will you be looking at, maybe you've not reduced commission so far, would you be looking at that going forward?
See, life insurance is a business where you have to be continuously analyzing all the components that go into it. We need to respond to changes also. Particularly when it comes to improvement in mortality, that has to be passed on. The returns that happen, the changes in the interest rates that happen also need to be absorbed. So it's always a continuous job of review of our experience, and based on that, changes will be brought in. That is one thing. As of now, what we are looking at this as a standalone impact of ITC not being available. We are trying to manage it. It will have an impact, no doubt, but we have been continuously focusing on improving the margins. So we have already seen the traction happening.
Yeah.
So what we are looking at, though there will be a small impact of the ITC not being available, we are trying to manage that by a good growth in the top line and the contribution from the business performance, as well as by the rationalization of other expenses. So we'll be able to manage that. That's the confidence that we are having currently. Going forward, we'll keep a continuous tab on that, and we can review at any point of time later.
So the option of reduction of commissions still remains on the table?
Currently, no, we are not considering that. We are looking at managing the input tax credit issue by improved top line performance. That's what we are looking at.
Okay, and what is the strategy to drive improved top line performance? Is it more of the product mix? Is it more focused on ULIPs, etc.? What is the strategy there?
See, already what you have seen, the product mix change has helped us in improving the margins. That is point number one. Two, what is happening? The market flare keeps changing. Customers start preferring more and more guaranteed products. It becomes easy for the people to understand also. So there has been a traction on guaranteed products, by which the non-par contribution also gone up. Of late, there has been a good traction on ULIPs. So in the current year, we are showing a good growth on ULIPs also. Though ULIPs is not very high on margins, but it has a very good potential to give a top line growth. So we have a mix of all these things. You have a mix of the product focus. We have the mix on improved productivity of our intermediaries, particularly the individual agents, as well as the focus on bank assurance and alternate channel. All these things will contribute our increase in top line. That's what we are looking at.
What do you see as the continued growth in ULIPs? Like you said, ULIPs growth has been pretty strong. I think 22% is the growth that you've seen in just the ULIPs segmentation. What is the continued focus for ULIPs and the revenue share that you see coming in, or do you not see it changing too much?
No, we are not. See, our strategy will be to see that we align with the customer preferences.
Yeah.
New product launch will be based on what the customers want and what feedback we get from the ground level. We have been trying to meet the expectations of the customers in terms of new product launches as well as bringing in the returns to the expectation of the customers. These are the two main areas of focus. So when we are looking at that, now the focus on ULIPs has been very heavy from the customers and the intermediaries point of view. So we have been able to target that also. And there has been a consistent demand for annuity products. So that is also one more area that we are looking at. And on the non-par savings as well as par products. LIC has been a very heavy contributor in terms of participating products.
Yeah.
Only thing is, from of late, we have started focusing a bit more on non-par, and there has been a change in the way we are bringing about in the product mix.
Why is that? Why the focus on non-par, and how do you see that going forward?
No, see, that's right. You have to keep in alignment with the market trends.
Yeah.
So when guaranteed products make it easy for a customer to understand and they know what exactly they are going to get out of the product, it becomes easy for the seller to present also. Of course, the participating business had its own charm because they have a share in the profits of the corporation also. There is a separate market for that also. Only thing is the growth has come largely through non-par in the last 2 or 3 years, and that has resulted in increased share from non-par products.
Okay, and you expect that to continue, that trajectory to continue?
The momentum that has already been built will continue for some more time also. I'm sure that will take the growth in non-par also to something which is slightly better than this in the days to come.
Okay. A bit about persistency ratios and basically the stickiness of the customers coming in. What are the trends that you see there, and will you hope for improvement in the second half?
It has been a continuous focus to improve the persistency of the, but we are a all segment player. So we look at all the segments of the society, and there are policies which are having a low ticket size. So the policies with a low ticket size have a tendency to be varying in persistency from time to time, depending upon the variation in the incomes of these customers. But we have been taking enough follow-up steps to ensure that the policyholders who have not paid the premiums are followed up and they are reminded, and we have been floating revival campaigns, giving some additional benefits to those customers also, and that has resulted in our increase in the long-term persistency of LIC policies. If you look at 61st month, we have been continuously improving. So the long-term persistency we have been improving, but in the increased ticket size that we have introduced in the last few years, we are also looking at an improvement in the 13th month and 24th month as well.
Yeah. So, okay, so that focus is continuing. Just a broader sort of trend kind of question before we wrap up, because you have such an vantage point of understanding where the trends are going. And you talked about longevity. Longevity, better understanding, more awareness. What is the trend that you see for life insurance going forward as people think about this also as a retirement corpus?
Yeah. See, the focus keeps changing of the customers. When the demographic profile of the customers change, the focus from dependency on one person's income to building a corpus for retirement and future, this change is going to continuously happen. With markets evolving the way it has been happening, with a lot of gig workers, with a lot of informal economy building up, the focus on building up someone's retirement corpus on their own is becoming more and more well pronounced. That is where you find the pension products and the annuity products getting more traction. And the interest rate scenario change in the market also gives a rise to this more dependence on ULIPs for getting a good return based on market. Is also something which is finding a good amount of traction in the last few years.
Yeah, and I think those are trends that will definitely continue.
Yes, there will be an increased focus on term insurance plus products like ULIPs as well as on annuities. These are all the things which are likely to improve. Though our savings bucket continues to be enjoying a preferential treatment in some segments of the society.
Okay. Thank you so much, sir, for speaking with us today.
Welcome.
And sharing all your points. So the outlook is quite interesting. First half had some of that GST impact, but the plan here, the strategy seems to be to focus on top line growth, volume growth, to mitigate any kind of pain from the lack of ITC. Thank you so much once again.
Thank you very much.